Hey guys, welcome. Thanks for hosting us, Robert. All right, we're going to talk a little bit about DeFi. My name is Chris Perkins. I'm the president of Coinfund, one of the managing partners. We're investors. We've been around for 10 years, and we invest in early stage founders. And gentlemen, do you want to introduce yourself? Matt, want to start?
I'm Matt Mena. I lead research in the US for 21 Shares. We are an ETF provider for crypto. We have about $10 billion of AUM, about $5 billion in the US, $5 billion in Europe, about 45 different products across the US and Europe.
Christopher.
Yeah, I'm Chris Robbins. I am the head of growth and strategic partnerships at Interop Labs. Interop Labs is the core devco for the Axelar protocol, which is a decentralized protocol focused on interoperability. So we provide connectivity across 80 plus blockchains to date.
All right, so we're going to talk a little bit about obstacles that are preventing traditional finance, mainstream finance, from adopting DeFi. So Chris, I'm going to start with you. What is DeFi? I mean, isn't that the problem? Like, it's not defined. You're a lawyer, right? So, like, what is it? And is that part of the problem?
Yeah, it's a really interesting question. And I don't think that there's a consensus on what is DeFi. I think, aligned with kind of the ethos of crypto, DeFi was rooted in the idea of disintermediation of central counterparties. So you could create a trustless system where you're operating peer-to-peer networks that are either governed by code as opposed to humans. And I think one of the challenges is that despite a lot of folks in the industry labeling themselves as DeFi or being a DeFi proponent, there's a lot of centralization at stake as DeFi protocols are designed. So from our perspective, we think of DeFi as rooted in decentralization, where there is an emphasis on a community of actors, validators that are broad in nature, who ultimately dictate, whether through the consensus mechanism or alternatives, like what transactions happen and don't happen. And I think that's a really foreign concept for institutions to think about, given that TradFi is really rooted in having centralized intermediaries who are highly regulated. So the notion to go to a big bank and say, hey, you're going to connect peer-to-peer networks and you don't have central counterparties in the same sense. You don't have custodians in the same sense. It's still quite foreign. Obviously, there's progress, but I still think there's a tremendous amount of variance in our collective understanding of what DeFi is.
I agree. I think this is one of the biggest challenges to institutional adoption. It's not just that it's a new concept for them. It's that they don't even, regulators have no idea what they're talking about. The entire regulatory infrastructure is predicated on intermediaries. I mean, I've spoken to agency chairs and they're like, well, what am I supposed to regulate then? And you're like, dude, you're supposed to regulate activities. You're supposed to regulate behaviors and the institutions that use the protocol. Matt, you're at an ETF provider, which is a very centralized, traditional type of entity that what ETFs are. How are you thinking? How's your company thinking about DeFi? How are you thinking about engaging in DeFi?
Yeah, so pretty much we're thinking about, so you mentioned DeFi, it's becoming more centralized now in a certain sense. If we bring financial institutions into crypto, it's going to become more centralized. We're thinking about DeFi as a way to give access to crypto to the everyday investor, right? That's the good thing about crypto. It's a space where the everyday investor could come and invest. We were actually able to, in crypto in generally, retail was able to front run large financial institutions and everything. So we see DeFi as a way for retail to come and invest in crypto and get all the benefits that come along with it.
So, as an ETF issuer, are you going to be starting to deploy your ETFs on chain?
So in the US, it's a little harder right now, right? We need to see the SEC approve more regulatory framework. I think once the SEC approves a regulatory bill or a sense of a market structure bill, we may see more of that. But right now in Europe, we're allowed to do a lot more than we are here in the US. So for example, in Europe, we're allowed to actually stake our ETFs. Our Solana ETF, for example, in Europe, it's about $1 billion of AUM. We stake about 85% of it. In the US, for our Ethereum ETF, we're not allowed to stake anything. And I think we're going to see that change. For example, the SEC actually came back to all ETF providers and they asked to include staking for the Solana ETF filings. So I think we'll see, once the SEC allows more things to happen, we'll probably see more ETF providers moving on-chain, right? And I'm kind of see that with BlackRock. They launched their on-chain money market fund. And I think that's their way of kind of getting into on-chain activities and such. So, yeah.
Yeah, I know from our perspective, we're investors in Superstate, and these guys have a registered transfer agent. They're kind of bridging the two things together. And I'm kind of bullish that I think equities are going to be on-chain before you know it into DeFi, serving as collateral and other things. We look at it like the ETFs of the 1990s. And in the 1990s, the SEC was like, they're pushing back. And then a strong chair came in and he's like, why are you stopping this? Let's do it. It's a new wrapper. Now it's a $14 trillion industry. And like, I kind of see it the same way. So Chris, Axelar, we have this thing called the Genius Bill coming in. And our own Secretary of the Treasury is saying that it's going to be, we're going to see at first he said 2 trillion. Now he's saying like 3 trillion into these things called stable coins are coming on chain. Are you guys ready for that? And like, what does that mean for DeFi?
Yeah, the short answer is yes, we are ready for it. One of the things that we are investing a lot of time and energy is multi-chain deployment of stablecoins. So new issuers or legacy issuers who want to deploy their stablecoins across a whole host of chains, we are confident that we can support them in those endeavors. I think the challenge that we're grappling with is the actual use case of stablecoins. Like, yes, there's a proliferation of assets coming on chain, but there's less clarity with respect to how those assets in the form of stablecoins will actually be used. Obviously, payments is a big vertical that folks see a natural use case for, but there's so much else. And from our perspective at XLR, we're a little bit unique from an interoperability perspective, and that we've got a smart contract layer above the blockchain. So we look at what the opportunity for stablecoins has in broader financial transactions. So think repo transactions, FX transactions. So leveraging the smart contract infrastructure within Axelar so as to facilitate broader use cases of stablecoins beyond just mere payments or movements of assets.
Awesome. Well, one of the things in the stablecoin bill is that it suppresses interest. And one of my theses, forever has been, okay, stablecoins are great for payments. We know it's good for remittances and cheap and all that stuff. But it's also a pretty awesome store of value if you're in the developing world, even though it's a depreciating asset because there's no interest. So one of the things we've been thinking about is that these stablecoins, the people sitting in the developing world, they're not going to sit around with a depreciating asset. They're going to deploy it, right? They're going to deploy it to go on chain to drive yield. Is that something that you think is going to happen, particularly amongst institutions, in the space?
100%. We are in conversations with a couple of issuers who are looking for a stablecoin deployment, not just US dollar denominated, but others for access in the developing world. And I think there's this recognition, especially in sub-Saharan and Western Africa, of this kind of generational skip. So you had folks who were in West Africa who kind of skipped landlines and went to mobile. So from like an e-wallet, e-payments perspective, it's not foreign to them. So the thought behind it is that stablecoin deployment and US dollar denominated assets will ultimately be used as kind of primary payment mechanisms. Those assets will be staked or loaned to generate yield and kind of dissuade or rather encourage folks to kind of hedge their local currency risk, maintaining value, reducing inflation of the assets that they ultimately hold. So short answer is yes, we think there's going to be a lot of that activity.
Awesome. So Matt, one of the greatest things about ETFs is it abstracts, all that operational complexity of DeFi, right? And you just get access to that underlying asset. You're talking about how you're staking right now, et cetera. I have an 80-year-old father, right? And like he finally came to me, he's like, Chris, I'm ready. Bought Bitcoin and it went up a little bit. He's like, what's next? I'm like, try ETH. We'll show you how to do it. But it's all ETF based because it's all the operational complexity. Do you think that that's like the end game here? Or do you think that in time, institutions are going to be able to get into this thing called DeFi because operationally they're going to be capable of doing it?
Yeah, no, I think that's a great point. Like ETFs are like the opposite of like tokenization, right? Tokenization is bringing, the more of the TradFi markets into crypto. ETFs now are bringing crypto into the TradFi. And it just makes it easier for like your everyday investor to invest into crypto. Don't have to worry about wallet management. Don't have to worry about staking or anything. Don't have to worry about slashing or anything. So it makes it easier. And I think the next evolution would be like structured products. So like structured products wrapped in the ETF wrapper. The ETF wrapper has been like a great wrapper to ETF wrapper has provided access to hard to access markets like fixed income, emerging markets, and now crypto. So I think as time goes on, it will evolve into that. And that's how large financial institutions are going to get access to crypto is through ETFs.
So you don't think that there's going to be a day in the future where they skip over that wrapper and go into DeFi direct? Or do you think they're going to access ETFs in DeFi?
I think it'll be a combination, right? Like we have already seen Axelar, for example, work with like JP Morgan, like a Deutsche Bank, and a lot of other like TradFi institutions. So some may come into ETFs through whatever crypto protocol it may be. but some may go through ETFs. And we may see more of like the larger firms with like a couple of $1 trillion of AUM go through direct access. But you know, your smaller offices, like your family offices, they might go through the ETF wrapper. It just makes sense. And that kind of leads into like the next problem, which is like there's no like set like regulatory framework or like any set like risk disclosure framework into investing in the crypto, I guess. And that's also what makes the ETF wrapper easier, is that we do all of the complex like research and the complex like all the complex like due diligence that's involved in that. So like you said, it just completely just like it just abstracts away the complexities of investing in crypto just in general, or just using crypto rails in general.
Got it. Chris, tell us about your work with JP Morgan and the other asset managers to the extent you can. What are they interested in? What's the use case?
Yeah, so we've done a couple of POCs with some of the larger tier one financial institutions through a variety of kind of jurisdictional sandbox frameworks. So with JPM, the efforts were really focused on on-chain portfolio management. So the ability to kind of manage a portfolio exclusively on-chain. So this was a couple of years ago, but recently we've been working with Deutsche Bank and Memento through Project Guardian, which is orchestrated by the Monetary Authority of Singapore. And that focus was really on-chain fund formation and fund servicing. So we think that there's a really unique opportunity to kind of do all of the fund administration stuff fully on-chain. And you could do multi-chain distributions of payments. You could facilitate the use of the underlying LP interest and deploy it to a DeFi protocol to use as collateral. So we think that there's a whole host of use cases, and we're cautiously optimistic with the learnings that we've gotten and kind of the regulatory framework in Singapore that's kind of the next evolution of funds being on chain, and then the assets that they either hold or the LP interest in the funds being leveraged for broader uses within DeFi ecosystems.
One of the other obstacles we've seen is privacy or lack thereof, right? Institutions like privacy. Suddenly you start delivering privacy on chain and people go to jail because the regulators didn't like it, right? How do we reconcile those two things?
It's tough. Every single conversation that we have with institutional partners or prospective partners results in a conversation about privacy. And I think there are different strokes for different folks with regards to how much is ultimately required. I think that there's a real concern, especially if you were a trading shop, about front running. There are concerns about the identity of counterparties who they're engaging with. So we are in some conversations with some layer ones who are focused on privacy considerations. We're also in conversations with a couple of other service providers to think through how we can leverage zero knowledge tools to effectively shield certain aspects of the transaction. But ultimately, it's a balance of what regulatory expectations will be versus the needs and desires of the institutions that we ultimately work with.
Do you have a view, Matt?
Yeah. So I think we'll see like large financial institutions come on chain more to like permission chains as opposed to permissionless. And I think that's where like different protocols like XR, for example, may help like through the whole like interop between permission and permissionless and such. So I think that's how we'll likely see institutions come online. So through permission chains as well as like the ETF wrapper in general is how I see institutions likely coming online.
If I could just add, I certainly think that the entry point for institutions will be on permission chains, but I think that we are experiencing a pretty seismic shift in institutional views of permission chains. This was like 7-8 years ago. I would have been shocked if you had any of the major institutions talking about settling a transaction on a layer one public blockchain. And now I think that there is a recognition that for a whole host of efficiency reasons, there may be some value. And with Axelar, we are thinking about connectivity of the layer 2 permission chains to public chains, whether it be for settlement purposes or deeper access to liquidity. So from our perspective, there's this convergence, which we're cautiously optimistic about. Obviously, there are concerns about how this functions in a cross-jurisdictional manner when you've got institutions who are dealing with lots of jurisdictions, lots of counterparties, what ultimately is acceptable. Because we talk about interoperability from a technical perspective a lot at Axelar, but we don't really focus on the interoperability from a legal and regulatory perspective so that you can facilitate that cross-jurisdictional transaction, which ultimately is kind of the missing piece right now.
And as a follow-up to that, you see like these large financial institutions like launching their own like layer twos to go about this, or like how do you see it? Or, like specifically on like the Ethereum layer one, or
Yeah, I think that there's some layer twos that are permission, but I think it's still a bit TBD. And frankly, I don't think that a lot of institutions know how they want to deploy a stablecoin strategy or an asset tokenization strategy. I think there's this narrative that, like, if you're not thinking about these issues, you're behind, which is partially true. But ultimately, my view is if you're going to tokenize an RWA asset, or if you want to be in the stablecoin space, don't do it for the sake of doing it. Do it because you view there being a legitimate use case for your clients, or you think that there are demonstrable benefits from an efficiency or cost perspective. And I think that that exercise can be a little challenging to do in earnest. And I think it's early for a number of institutions. Obviously, you've got legacy players, JPM, Deutsche Bank, Standard Chartered, et cetera, who've been thinking about these issues for over a decade. But for most institutions, I think it's still relatively new. And to some extent, I don't think that they know what they don't know.
Yeah, from my perspective, I think one of the reasons why institutions haven't been able to come into DeFi is because of reputational risk.
Sure.
All right. That's manifested in a few different ways. One is that regulatory risk. These guys, they're smart. They'll take risk all day long. They're very comfortable taking market risk. Market goes up, market goes down. Oops, I screwed up my underwrite. I get it. But they don't get paid for reputational risk. And really, in the last 4 years, that manifested itself as regulatory risk because Gary Gensler was trying to put us all out of business and send us to jail. Now that's coming off. And I think DeFi, as you talk to senior regulators, they get it. They know it's important, but they've got to figure out stable coins first. Then what's a security? What's a commodity? Then they work with the other folks. They're going to get to it eventually, and they will. But regardless, that regulatory risk is coming off the table. But there's another risk that remains, and I think it's probably the most scary of them all, and that's security, right? If you're an institution and you're coming on chain, and the next thing you know, the North Koreans steal $2.4 billion, which they did, that's a real big problem because not only, is that bad you lost your money, they're taking that money for, their own nuclear weapons program. That's massive, massive reputational risk. So how do we navigate that? And I'll start with you, Matt, because you're an Air Force officer or Air Force enlisted, right?
yeah, I was actually
Sorry to promote you. You're in the Air Force. How do you think about security?
I guess that's one of the benefits of the ETF wrapper, right? It kind of abstracts away that security. We worry about it, we deal with it, not really on the other side.
Still get attacked though, right?
No, yeah, we could definitely.
But
still
you're more institutional,
right? Yeah, but that's why we use the different type of we use a multi custodian model. So we hold our assets in Coinbase, in and various other custodians. So kind of trying to mitigate that risk into multiple different the multi-custodian model. But on top, you mentioned the reputation risk associated with it. That's also starting to go away as well. As we've seen, the Bitcoin ETFs in the last 3 months have had $10 billion of net flows. Ethereum ETFs $1.4 billion of net flows. So I think that reputation risk is starting to come off the table, for example. And yeah, I think
that's because you're abstracting a lot of that operational risk and hopefully the security risk. But I don't think that was the ideal that Satoshi had in mind, is that go through a security wrapper, institution's going to figure it out, right? And now, Chris, we got $3 trillion coming on chain. Security is going to be a huge problem. What do we do about it?
Yeah, it's tough. I will say from the Axelar perspective, the entire protocol is designed with security in mind. We're the only major interop player that operates its own layer one blockchain. It's decentralized with a 75 validator set. And we think a lot about this because, security doesn't really matter until it does. And it's a bit frustrating to some extent. I think early days in the industry, there was a focus on, maintaining self-custody, security, et cetera. And there's a balance, especially with a lot of DeFi native tooling, where we got to move fast and break things, and perhaps we'll make some decisions at the expense of security considerations. The upside for institutions is that they don't have that luxury. When we go in and talk about potential integrations and providing support, you've got to convince the business line, but you've also got to convince the chief risk officer, the chief compliance officer, and get them up to speed to understand how the Axelar infrastructure actually works, how we disintermediate certain counterparties to reduce the risk, and what their actual tech stack looks like. So from our perspective, it's a constant conversation that we have and a selling point, and I don't think it's going away from the institutional perspective. I did want to make one point on the reputational risk piece, which is quite interesting right now. I'll put my former bank regulatory hat on, but there was a concerted effort among some of the big players to remove reputational risk considerations for bank risk ratings. And I think that aligns pretty nicely with being a little bit more adventurous and diving deeper into blockchain-based infrastructure, DeFi native opportunities, because I think that they're trying precisely to mitigate the concern about the reputational hit and that having an impact on their bank regulatory rating, risk rating, because that has implications for capital requirements, a whole host of other considerations that we don't want to get into at this point. But it's a fair point, and I know it's top of mind.
Yeah, I mean, if we were going to be honest with each other, one of the biggest impediments to adoption of crypto is bank regulatory rules. Basel, like they make you hold so much capital against any kind of holding. But before we nerd on that, let's go back to security. I'm just gonna tell you what I think. I think the only way we solve this is we go on offense. And right now we've been getting our asses kicked. What's happened is, we have young founders. They raise capital. It's really hard to raise capital. They spend all that money the last 4 years on lawyers to figure out what's a security and what's not. Then they get hacked. Not a lot of my portfolio, but a lot of them, some of them do. And then it's like, hey, we blame the victim because how dare you get hacked? You've sent money off to the North Koreans. And so if there's one thing that I could add to the panel, it's we need to go on offense. We do need to do it by going back to our constitution that allows for letters of marque, which empowers privateers, the private sector, to go on offense against our adversaries that are hunting our startups. And so hopefully you'll hear more of that in the future. But I think it's time. And wouldn't it be great? We lost so many entrepreneurs overseas, right? Wouldn't it be great if we welcomed them back? And one of the benefits you get is that you get this security umbrella of American privateers that if they mess with you, it's going to be very painful. So
Could not agree more. We spend a lot of time thinking about how we as Axelard Interop Labs can go on the offense. So, we responded to the Crypto Task Force's request for information and really honed in on decentralized interoperability and educating them on what the value proposition is from a securities law perspective, from a core security perspective, to ultimately differentiate between the hacks that have occurred because of central intermediary risk versus those that have not occurred when you operate a fully decentralized network. So from our perspective, there's still a lot of education. And frankly, in the interop space, there really hasn't been much of a conversation or thought exercise from regulators. So our view is we have to invest the time, energy, and resources to really differentiate ourselves from competitors and level set of this is what's analogous in the TradFi space. This is why we're different, or this is why something is non-congruent. Because at the end of the day, if we aren't on offense, ultimately we're kind of left to the whims of folks who have no idea how the core infrastructure works, and they're trying to take antiquated securities laws, commodities laws, or banking law and apply that to what we're doing, and it just doesn't work.
awesome.
Sorry, and I guess that's like a general question. Going on the offense, what would that look like exactly? Actually,
Yeah, so today we're not able to hack the North Koreans. Why? Because if you trade with the North Koreans, you're violating sanctions and OFAC rules. If you look back in history, we actually, I'm a naval officer. We won the Revolutionary War because our privateers ravaged the British economy, and they had enough. It wasn't Yorktown. It was like, hey, our economy's suffering. Let's let these colonists go. War of 1812, Madison authorized 5,000 privateers to go on the offense, and again, that helped end the war. Our country loves it so much, we put this concept in our Constitution. It's called letters of marque. And so the Congress is allowed now to give someone a license and say, you know what, go violate the OFAC rules, go violate sanctions, go hunt and get that money back. And then there's a historic prize courts that would allocate the money back to the right folks. It's also a tax-free way of funding the Bitcoin strategic reserve, to be honest with you. So that's how the concept would work. We just briefed it up to the crypto, to Bess and Lutnick. So hopefully we get some traction. We'll see what happens. All right, we're going to wind up here in a second, but apps. What apps are the institutions going to use in DeFi? How's it going to evolve? Where are they going to start? I know I have a portfolio company that's going to start, pushing out direct listings on chain. So I could see DEXs start taking off. What do you guys think? What apps are going to be the first institutionally adopted ones?
I think power lending / tokenization. Honestly, stablecoins have been the killer use case of crypto. We've seen that with Circle. At one point, it actually flipped its USDC market cap, actually. So the actual stock of Circle flipped USDC, which is kind of insane to think about, really. So it shows that the market really wants a way to invest in stablecoins. We saw plasmas all out in like 5 minutes or whatnot. So
Yeah.
I feel like stablecoin slash like tokenization is where we're likely going to see institutions come into the space within the next year or two. And it shows, right? Like the right now we're looking at the Genius Act. The government is trying to tie in the Genius Act and the Clarity, or certain aspects of the government are trying to tie in the Genius Act to the Clarity Act. So I think once we see the Genius Act pass, we'll see stablecoins become more of like the de facto use case for crypto. And then once the Clarity Act or whatever type of market structure bill may follow up with that, we'll like see that come in too. So I think tokenization slash stablecoins will likely be the app where we see pretty much crypto get used.
Sir?
I'll break it into two pieces. The first is use of assets that are issued by institutions and where they kind of fit in. And I think those apps will be their clients deploying those assets as collateral in DeFi transactions, whether that through DEXs or other DeFi protocols. For the institutions in their direct interface with DeFi, I don't think those apps exist yet. It's incredibly difficult from an institutional perspective to integrate yourself into DeFi. So I think the onus is really on us to collectively build those apps over the next 12 to 24 months.
So if you know any founders, send them my way. We'll do what we can. Awesome. Well, thanks, gentlemen, for joining us this evening.
Thank you.